Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Author, entrepreneur, financial advisor, and blogger Garth Turner is back. Check out Garth's blog at greaterfool.ca, and you too can become a blog dog. Hey, Garth, it's good to have you back.
Thank you, Phil. Pleasure to be with you.
Garth, I want to point our listeners first to your latest blog posts, Soft Landing and Soft Landing Part 2. I don't want to give away the ending here, so let's start with our diminutive yet all-powerful finance minister, Jim Flaherty, making the news this week. F says he's pleased the condo market has moderated. Isn't that good news?
Well, it's good news because this means that the housing bubble that he said never existed and now he's worried about is not as much of a problem. And if you can figure that one out, you're better than a man than I am. But he really wants the real estate market to deflate. There's no doubt about it. The feds have done so much in the last year to make this happen, and they continue. The latest change actually is ongoing right now, and it is the banning of 30-year mortgages. I mean, that came out of the left field. I don't think anyone really expected that was going to happen, but it's consistent with what they've done. So one move after another, these guys are definitely not going to finish until they think the real estate market has lost all this air.
Garth, I thought this was old news, but maybe it's not to the folks at Canadian Mortgage Trends. Canada's banking regulator, the OSFI, says it's looking at rules that would limit amortizations to 25 years. Is that old news?
Well, it was old news that if you wanted an insured mortgage, in other words, if you only had 10% down, for example, and you wanted to buy a house, you couldn't get a 30-year mortgage anymore insured. But always the banks have kept up 30-year offerings. Even 35-year mortgages are still out there. It's just you need to have a bigger down payment. But what does that mean? Well, it means that actually people can, if you can cough up 20% down, you can still have a really low monthly payment. And many people are able to get further into debt because they, taking on more money, even though they have a large down payment because of these 30-year amortizations. Sure. So it is news now that they're actually going to ban them. And I found it ironic as well that Mr. Flaherty saying as well the other day, well, I don't need to meddle in the mortgage market anymore because everything's fixed. Well, at the same time, he's actually meddling up to his kneecaps. And it was only a few weeks ago that he told mortgage companies that they couldn't offer cut-rate loans.
Yeah.
So the government is being very, very involved in this.
I try to imagine a guy like Ben Bernanke calling the Bank of America, telling them to hold their 10-year rate.
Yeah, they tell them where to hold other things, too.
I can't let Flaherty go this week without passing this quote along, Grace. Something you've been alluding to for a while from Jim Flaherty this week. I think these are healthy developments. I think we're beginning to see some indications of the beginning of a bubble.
Yeah, well, there you go. This has been ongoing for a long time. You and I have been talking about this for the past couple of years. People are living this day in and day out in the Lower Mainland and the Okanagan Valley right now in Victoria. They know what happens when a bubble deflates. The buyers disappear. Prices have to go down, and that's exactly where we're in right now. So, the horse left the barn. He's on his way to South America, and now they're closing the door.
Garth Turner from greaterfool.ca here on This Week in Money. Garth, let's talk about the new TerraNet house price report out this week. The big headline in the Financial Post this week: Canadian home price growth slumps to slowest pace since recession. What's going on here?
Well, that's true. The pace, let's first start by saying TerraNet National Bank Housing Price Index is not, I would call, extremely accurate.
Okay.
It's interesting. It's about as close in Canada as we have to the Case-Shiller report in the United States, but it's not a terribly accurate survey. Having said that, it does have some merit. All of them do. It is now showing that the growth in prices has slumped to the lowest annual increase since we've had in quite a number of years. It also shows that 6 out of 10 major Canadian cities are now seeing year-over-year flatline or slight decline in prices. So it's not a rosy report at all. However, I must caution people listening to this broadcast. that the thing you want to look at right now is not prices, but sales. Sales decline first and prices later. So if you want to know where prices are going to go, have a look at where sales are trending now. This is a very different story indeed. And there are year-over-year sales decreases now in every single major market in Canada. I can't remember when that was ever the case before.
Got the latest here, Garth, from Vancouver. Colliers International reporting a 45% drop in sales of multifamily homes in Metro Vancouver.
There you go, Phil. Yeah, exactly to the point. And we're seeing it in Vancouver. We're seeing it in Toronto, Montreal, Halifax, Winnipeg, Saskatoon, everywhere now. Even Calgary. Even Calgary's had a year-over-year price decline, and that's been the hottest market in Canada. Mm-hmm. So sales are telling us what's going to happen next, and they're clearly telegraphing that prices are going to be following suit. People get impatient. They think we're going to have a U.S.-style crash.
Yeah.
Prices are going to go down 30% in 6 months, but that's not the way this is going to happen. It's going to play out over quite some period of time.
All these numbers we talk about are just that. They're numbers, and they can be inaccurate, and they can be skewed, and they can be spun any way you want to. But compare the Terranet numbers to the numbers from Case-Shiller in about the same period, Garth, February to February. 2% in Canada, 9% in the U.S.
Yeah, the American real estate market is going in the opposite direction. In fact, Canada and the United States are now both going in the opposite direction in terms of so many economic indicators. It's quite interesting. I mean, take a look at the stock market, Phil. I mean, the Dow and the S&P have set major new records almost every session. The Dow's up 16% this year. The Toronto stock market is barely flat.
Yeah.
So there's a huge thing. The American real estate market is rebounding. Canadian is falling. Hell, even prices in Detroit are up 14%. My goodness. I guess that means you can get an average house for $2 now. But anyway, what a difference.
One last look at the Terranet numbers here. And I found this kind of interesting. Except for April 2009, that's when we were in a recession. It was the weakest April monthly change in 15 years. If you did not include Winnipeg, Edmonton, and Calgary, the numbers would have been basically flat.
Well, who cares about those cities anyway, right?
Exactly.
Yeah, just put them on the margin. But no, it's quite right. And let's remember, this is spring, right?
Sure.
I mean, this is prime time. This is the horniest little time of the year for real estate. And secondly, let's not forget that mortgages are still available at 2.7% right now. So, man, I mean, if real estate is starting to stutter in this environment, I think you really need to be careful about going out there and buying.
Garth Turner from GreaterFool.ca is here with us on This Week in Money, and we talked about the Terranet numbers and what's going on with F. How about the spin that we're hearing from our old buddy Greg Klump and the realtors? What are they saying about what's going on?
Well, realtors, of course, tell you it's a balanced market, and there's never a better time than now to buy, Phil. What a dumb question.
Of course, I'm sorry. What about the bank economists? These guys are trying desperately to catch up with the hype that the realtors are putting down, are they not?
They are. And you have to remember, there are many very accomplished bank economists, but they're also tied at the hip to the mortgage market. And the banks are the largest mortgage lenders, and about 35 or 40% of the entire bank assets are determined by their mortgage portfolio. Wow. So, I don't completely trust the analysis that many of them come up with. I mean, there was one the other day from CIBC, Benny Tall. I know Benny. He's a good egg, but man, this report was over the top. He was saying that, when he looks at demographics in Canada, he sees all these, 25 to 45-year-olds who are going to rush in and buy houses, and over the next decade, it's going to be a 400% increase in demand. Well, man, I mean, he says it's just like it's going to be in the 1990s. Well, Phil, prices of houses have more than doubled in that period of time. Incomes have not doubled. And my goodness, there are so many people in their late 20s, early 30s now who are really struggling to not only find a job, but find a way to move out of their parents' basement. I just don't see a big demand there.
Tell me, Garth, about this note that you got from Ross Kay. He's a realtor in the Greater Toronto area. What's he saying about some of the numbers and the misleading data that we're seeing here?
Yeah, exactly, Phil. It's not just that guy. There's a number of others. There's a prominent realtor in the west side of Vancouver, Sam Wyatt, who has been saying kind of the same things. There's a number around the country. There's a lot of realtors who are frustrated right now because their real estate boards keep pumping out these numbers and these statements that are, basically misleading consumers. If I were a realtor right now and I had someone thinking about listing my home, I'd be trying to make sure they were realistic and they didn't ask for crazy prices because they're just not going to sell their home. So that's one challenge for realtors right now, is making sure that buyers understand the realities of the marketplace and price appropriately. Secondly, there is a duty on the part of ethical realtors not to get young buyers in over their head and buy properties with a small down payment that probably are going to put them underwater in a year or two. So the responsible, ethical realtors out there, and there are many of them, they are just as frustrated as anyone else at the fact that the consistent message gets pumped out there that the market's in great shape and people should go and buy.
I'm going to ask another dumb question here. Why is this frustration not filtering its way up the chain of command?
It's the nature of the business. Yeah. Most real estate people are entrepreneurs. They're independent agents. They have a loose association with their broker. The broker has somewhat of a loose association with Remax or Royal LePage or whatever the company is. And it is a very sort of disjointed industry made up of a lot of people who are kind of hired guns. And, if you're a realtor in many situations, Phil, you actually have to rent your desk. You have to employ your own employees out of your own pocket. It's very much an entrepreneurial situation. It's not like being an employee for a large company where you can march in, talk to the CEO, and maybe get something done. So I do feel for a lot of these people. And over the last number of years, we've had thousands and thousands of realtors, new people pour into the industry in major markets. And a lot of those people now are be lucky if they have one sale every 2-3 months. Yeah. They're basically starvation time is setting in.
Garth Turner from GreaterFool.ca here on This Week in Money. Garth, you got to wonder if Bob Rennie, he's a Vancouver realtor, has been into the BC Bud. Headline in today's Vancouver Sun, Condo King says downsizing homeowners will sell single-family homes and help pay for kids' purchases. Obviously, he's never read your blog.
Oh, man. Well, Bob Rennie is a very creative guy, and he just never stops. He's been on this little tangent for a while now that, all these baby boomers are going to sell their houses and split the money with their kids so their kids can go off and make these big condo purchases. I just don't think it's going to happen. In fact, there was a study the other day, which I found spoke to the opposite of this, basically saying that so many baby boomers have adult children who have failed to launch, who are living in the basement and who are continuing to be supported by their parents, that you got a lot of people who just are not ready for retirement. And they may be 60-year-old boomers, but man, they are in bad financial shape. And if they own anything, they own a house, and that's it. So the idea of selling that house and forking over the proceeds to your kids so we can go and buy a condo so you can stay at home and eat cat food, I don't think is exactly going to work.
I guess that's what brought this to my attention, was the fact that there seems to be such a huge disconnect between what he's envisioning and what you're talking about every day in the blog.
Yeah, most people are not in great shape. I know Vancouver, for example, the most expensive real estate market in Canada. There's 5,000 houses listed right now for more than $1 million. That seems like a fantastic amount to many people across the country. However, to live in Vancouver and have an average home means you probably don't own anything else. You don't have an RSP or a TFSA. You don't have hundreds of thousands of dollars, even just before you get to retirement, sitting in investment accounts. You've got a house. And right now that house is increasingly illiquid. So, no, it's an illusion. Phil, and I think there's a lot of people who are really wishing that, they'd all move to Moosonee or someplace cheap.
Garth Turner from GreaterFool.ca is here with us on This Week in Money, and we're talking about Garth's post, Soft Landing Part 1 and Soft Landing Part 2. You're asking the question, if prices aren't falling, why are sales falling?
Well, as I said, sales are the leading indicator. Prices will come next. People tend to think that if sales go down, prices should be going down and that they should move concurrently. They don't, and there's a big lag between them. The lag is probably 6 months to a year, and that's a reasonable thing. When many sellers can't find a buyer, they'll keep at it for 3, 4, 5, 6 months before they finally give in and lower their price a bit. It takes quite a period of time. There are some multiple bids in certain parts of the market, and that tends to get the media attention. Secondly, we've got all the real estate people, the cartel, I call them, the real estate boards and companies who are pumping out the kind of messages we talked about just a minute ago. So lots of consumers are quite confused about where the market's going. The media doesn't help. When there's a new report that comes out on sales and prices, generally the headline is, well, sales are up year over year 2%, even though sales may be down from where they were 6 months ago compared to this time last year, they may be up a bit. So, Phil, it's really, really misleading and confusing, and I can't tell people enough to really be cautious.
Garth, look in your crystal ball for a second here to the next 3 to 6 months over the spring and summer period. What do you see happening in Canadian real estate? What trends are going on now that will continue?
Well, I think we're at the high water mark right now. I mean, in April, May, good weather, low interest rates, people feel better about the spring. This is really about as good as it gets. So I think the next number of months are going to bring falling sales, and I do think we're going to see the start of more serious price corrections. If you are a seller, I really hope you adjust your price accordingly right now, and even if you think you're going to sell for a little bit less than you wanted, I definitely would take it. If you're a buyer, my advice, wait.
Garth Turner from GreaterFool.ca, our guest here on This Week in Money. Boy, if you're thinking about what to do for the next little while, I can't do anything better than look back. I guess this will be a couple of years ago in your blog when people were asking what to do, and you said, number one, if you live in a market where real estate is still alive, get out.
Yeah, I think so. I think it is going to be a very poorly performing asset class over the next number of years. Let's remember that people who invest in liquid assets, whether it's stocks and bonds or ETFs and those sorts of things, they've generally, on a fairly conservative portfolio, they've been able to be getting around 8% a year for the last number of years. Last year was more than 10%. This year, it's about the same. Now, real estate is starting to compare very badly with liquid assets. A lot of people have in the back of their mind that 2008, the market meltdown, is just around the corner again, and they need to invest in something safe like a house. Actually, it's the opposite situation now. And I think the tide has turned. So I would encourage people, if you're starting to get serious about retirement planning or building assets up, you really need to diversify. And remember, don't put too much of your net worth into a house. It's just not going to work out well.
What's the Canadian average, Garth? About 70% of Canadians own a house?
Yeah, 70% of Canadians now own a house, just a little bit more than that. It's interesting that 70% number is also the number of Canadians who don't have a pension.
Bingo.
So, yeah, this is getting into serious territory.
Garth Turner, author, blogger, financial advisor, and entrepreneur is our guest. You can find Garth on the web at GreaterFool.ca, and you can also follow Garth on Twitter at Garth Turner. Hey, Garth, always interesting to talk to you, my friend. Thanks for taking your time.
My pleasure. Thank you.
This Week in Money is archived online at TalkDigitalNetwork.com.
Robert Campbell publishes the Campbell Real Estate Timing Letter. Hey, the May issue is out. You'll find him online at realestatetiming.com. Bob is in San Diego, California. The focus obviously on Southern California, Bob, but we are always glad to get your take on U.S. real estate trends. Good to have you back on This Week in Money.
Thank you very much, Phil.
Bob, got the latest word from the folks at Case-Shiller a couple of days back. U.S. home prices up 9% in March from a year ago. That's the biggest jump since the top of the boom in way back in 2006. I guess that's good news.
It is good news. I mean, the it's good for the U.S. economy. It's good for people that own houses. Anytime assets are appreciating, that certainly has a positive effect on people. Of course, what's the fuel that's driving that rise is equally as important, because that determines whether it's organically driven and sustainable, or whether it's a government driven boom, to keep the wheels on the car.
Bob, let's talk about what is driving house prices up. And you illustrate very clearly in the Campbell Real Estate Timing Letter, starting with sales of existing homes.
Well, it's almost to a very large degree, Phil, and this has been the case, since this boom started. It's been interest rates. Because when the Fed started its QE programs, which is quantitative easing, and Operation Twist, which was back in, I think, November, December 2008, you can see what's happened to interest rates, and if you compare the maturity of the bonds that the Fed has purchased and compare it to interest rates, there's a 94% correlation with the direction interest rates are going. That's a very, very high correlation. Now, during that same period, since late 2008, real incomes in the United States have fallen 8.8%. So now you have a boom in the United States in housing that's highly tied to incomes when incomes are down 8.8%. Needless to say, the fact that housing prices have come way off in a lot of areas explains some of that. But the majority of that is being driven by low interest rates, ultra low interest rates, and in that respect, the Fed has really painted themselves into a corner, Phil, with respect to saying that, we're thinking about, backing off of the QE somewhat, or executing our exit strategy to get some of these mortgages we've been purchasing off our balance sheets. It's just all words. There's no way in the world they can do it because of the state of the U.S. economy.
Bob, what are the interesting angles from the latest Case-Shiller? The prices are up in all 20 cities for the second straight month. Does that mean the recovery is going on, or is it simply too soon to tell?
Well, the Case-Shiller 20 cities are all, big major U.S. cities. So I can't speak that that's happening in all the smaller cities, but what it does show is that it's broadly based throughout the United States. One area is not benefiting, doing well, while another area is not.
Bob, we have some bad news in all this, and that probably is for Canadians who are interested in U.S. real estate. Biggest gains, according to Case-Shiller, in Canadian hotspots, Phoenix, Las Vegas, and San Francisco. Now, from where you are, what do you see?
Especially with Phoenix and Las Vegas, those were the two, I believe, hardest hit markets in the United States, and housing prices fell in both of those areas. My goodness, I believe, 70%. And so when housing prices came crashing down, they overreacted to the downside. That incomes, there were always lower priced areas, and incomes have fallen maybe 8%. So when it comes to the affordability factor of owning a house, the affordability is highest in those areas. San Francisco is just doing its normal levitating effect, that they've defied all laws of what goes up must come down for the last 20 years now, and for whatever the reason. But they've experienced big uptrends. Their downtrends have been rather mild, and now they're back on the back in the boom phase again. So they've been really, really fortunate up there, especially from this on the peninsula, from the city all the way down south to San Jose / the Silicon Valley. There's a lot of those techie guys make a lot of money, Phil. There's not as many service-oriented jobs as there are, low-paying service-oriented jobs as there are in most cities. Those highly technical jobs require highly technical skills, and the people that have those skills are well paid. You
and I were talking off the air, Bob, about San Francisco house prices being comparable to those in Honolulu or, God forbid, Vancouver.
Right. That's really amazing. That the fact that that Vancouver is, and I've never been there, so I can't speak, but the fact that your average housing price is up around $600,000, my God, that is a big, big number.
Interesting. Also, from Yahoo Finance today, the Canadian takeover of U.S. real estate. We're talking about Canadians buying American real estate, and obviously a lot of our listeners are thinking of maybe doing that kind of thing. From the National Association of Realtors, 7% of all U.S. residential properties sold last year purchased by international buyers, and about 20% of those were Canadians. And you can see why with prices being so low in the States.
Yes, I mean that's really a surprising number, 7%. I don't have any historical data to compare that with. How does that compare with the like a 20-year norm, Phil?
Good question. They don't give us any information on that.
But I think that's a big number, and with the U.S. dollar being exported, with our negative balance of trade that we run every year after year, these our trading partners are literally choking with U.S. dollars, and either they save them or they bring the money back to buy in the United States, and I guess they're using some of that money to take it back to the United States and buy real estate, which makes sense. I'd rather do that than hold the U.S. dollar.
Robert Campbell from realestatetiming.com, our guest here on This Week in Money. Speaking of the U.S. dollar and the U.S. government, amazing stat from your blog here. The U.S. government backs 97% of all mortgages.
Wow, yeah. I know. That's just further evidence that we are in a real estate recovery, and even our U.S. economy is almost 100% on life support from the U.S. government and the Federal Reserve Board, Phil. And that's the alarming part of all this. I mean, yes, everybody's heard that don't fight the Fed, and that's true. However, you get to the point where, everything is more or less based on the government stepping in and doing things. Not only do you not have a free market economy that's driven by free organic market forces, that you set up a case here where, eventually the currency, loses more and more value, and the risk of a significant devaluation grows greater and greater, which is unfortunately the direction I'm almost positive that we're going.
Bob, what do you make of the latest coming out of the Fed? Here's Richmond Fed President Jeff Lacker yesterday saying an improving U.S. housing market says it's time for the Fed to stop aiming stimulus at real estate. And Dallas Fed's Dick Fisher, he says the recent pickup in values is a sign the central bank shouldn't be purchasing any more mortgage-backed securities.
Well, I think he's just just running his lips just to be saying something, But these guys know all too well that if the Fed was even to slightly back off of the accelerator pedal with respect to buying mortgages and keep interest rates falling or as low as they are right now, as opposed to just backing off and let them rise back to their natural, supply and demand levels that they normally would, that it would be a disaster for the U.S. stock market. It'd be a disaster and especially a disaster for the U.S. housing market from the standpoint that, driven by interest rates is what's taking prices up, and lower interest rates, so it'd be higher interest rates is what would be taking it down. But all the debt that has been created, Phil, that's another reason that they have to keep interest rates low, just like they're doing in Japan right now. They're forced to do this to keep interest rates low because they're creating so much money and creating so much debt in order to keep the economy alive. If interest rates were to start rising on all that debt that we've created to support the economy, oh my God, the interest rate expenses on the national debt would start screaming higher, which would make the national debt deficit that much greater each year, which would then require that much more money printing by the Fed to make up the difference. So I just don't see it happening. It's in a lot of ways I think these guys are maniacs and they're taking us on a highway to hell. Yeah. With respect to their actions, and I don't see them backing off from this. at any point in time, it's going to be the markets that's going to make us do that, and it's probably going to be in the foreign exchange markets where we see the dollar take a big crash because they know that those obligations can never be paid back with real money.
Boy, you talk about a vampire economy. I could not believe this when I saw it in the May issue. I thought it was a typo the first time I saw it. I'll quote you here. Even with today's low interest rates, the U.S. economy is experiencing its second lowest decade of growth, GDP growth, since 1790. I thought it was 1970.
No, exactly. We're going back 220 years.
Wow.
Yeah, exactly. And a lot of that growth has been fueled with deficit spending by the Fed. So that shows you what has happened in the last 10 years has really been amazing, especially here in the United States. We've had two stock market crashes, one in a dot-com crash in 2000 and a financial crisis in 2007, 2008. We had a real estate crash in 2006. And the fact that that we're offshoring so many of our jobs to low cost manufacturers, outside of overseas, that's telling you why our job situation is so bad. But it's everything in life ebb and flows. And right now, the U.S. economy is ebbing away, and that's exactly what's happening. That especially on the job side, that if you ran a major corporation here in the United States, and you saw that because of the baby boomer demographics, the fact that you can keep your shareholder stock prices higher by cutting costs as opposed to increasing revenues or even doing a little of both, you're going to do it. And that's why, that the share prices, the stock market probably isn't as overvalued as a lot of people want to think it is, even though it's sky high, because their earnings are still high because they've taken the jobs elsewhere. In other words, they're keeping their profits high because they've cut costs on the labor side, which is really damaging the U.S. economy.
Bob, tell me about the baby boomers and how they impact U.S. housing.
Okay, for your Canadian viewers that don't know, after World War II, from the 14 years, let's see, 1946 through, I think it's 1962 or 64. There's 18 years there, Phil, where we experienced a very rapid growth in making babies. And we call those baby boomers.
And we have the same thing happening in Canada.
I didn't know you had that in the United States.
Sure.
Well, here's what happens with people. Their prime, as consumers, their prime purchasing years are in between the ages of 35 years old and 54 years old. After that, the next 10 years after that, I think that consumption falls off. And then when people get to be 64, past 64, that consumption drops off a total of 28% from peak years. Well, interestingly, the United States economy it's primarily driven by consumer consumption.
Sure.
71%. So not only do we have the economy, in a hole, but also we have 10,000 baby boomers every single day that are retiring, which means moving past that age of 65, and that means they're gonna start slacking off on their consumption, on their consumption, meaning that they're not that there's a huge chunk of the population that isn't going to be the support for the economy that it once was. And so that's very, very troubling from an economic standpoint, and from the market standpoint, from the real estate standpoint as well.
Yeah, that's got to have a big effect on housing because, as in Canada, with all those boomers downsizing, there's going to be a huge glut of homes on the market.
Oh, I think so. I've told people for years. I think California is the most expensive state in the United States, and I've been telling people that that you're going to live to be 85 years old, whether you like it or not. And if you own a home here in California, and a lot of people, when they get older, they own a home free and clear, just to release some capital so that you can help support yourself, because Social Security isn't going to do it, and a small pension isn't going to do it. But just to do that, you're going to be forced to sell your, $350,000 median-priced home in California and move to Kansas and buy the same house for $100,000, and now at least you have $250,000, extra money in which to live.
Yeah.
But I think that's definitely going to be, it's definitely going to happen just because of the mathematics of how long we live and how much money people have.
Robert Campbell from realestatetiming.com, our guest here on This Week in Money. Wanted to run through, Bob, some of the other Case-Shiller highlights and get your take on what they're saying. Starting off with prices. They're saying they will increase just under 4% annually over the next 5 years. Is that sustainable, you think?
Well, yes, I do think that is sustainable, but I don't make any forecasts whatsoever.
Yeah.
I've learned from, in all my years of tracking markets and tracking the best of the best guys, that data speaks more strongly than opinion. Mm-hmm. But interesting, though, when they say real estate is going to appreciate 4% a year over the next, nationally over the next, 3 to 4 years, I think that's going to depend a lot upon inflation, because historically, if you use, Robert Shiller, who created the Case-Shiller Index, his long-term price history of the United States that goes back to 1890, housing has only appreciated approximately, over the long run, less than 0.5% above inflation.
Okay.
So, but to say that they're going to go that high, keep appreciating at 4%, I think that's very doable. I think that's very doable over the next 3 or 4 years, if in fact we don't have a free market shock to the economy. Sure. that's really gonna set off a rebalancing act in so many ways. That's going to bring us back to a lower standard of living. I doubt that we're going to make it 4 years, Phil.
Here's the second highlight from the Case-Shiller report, just came out this week. Cities that suffered the most during the bubble and the crash obviously will show the biggest gains, and obviously that's being driven by demand from investors.
Right. Yes, it is. Absolutely. The hedge funds are coming in these low price areas and have bought up a ton of inexpensive real estate. Most of it's distressed real estate, REOs from banks and things like that. So that's another problematic thing. Normally, in a normal market, 15% of all real estate in the United States is owned by investors. And during this recovery, over almost 30 or double that amount is owned by investors. And what people are kind of jittery about is saying that, these hedge fund guys, are they in it for the long run or to make a fast buck?
Yeah, that's a pretty simple answer.
Exactly. So, when things turn south at any point in time, when these guys are going to turn with it. Sure. And try to get out of the market, and then all of a sudden there's going to be a disproportionately high percentage of investors that are going to be running for the exits.
Here's the third highlight, Bob, from the Case-Shiller study that just came out this week. New housing bubble in the States, they say unlikely.
We're not there yet. I would agree with that 100%.
Okay.
Now, when they say unlikely, of course that's what they're going to say. But from a standpoint because if you look at where we are in the Case-Shiller Index right now, even after the 9.3% year-over-year rise in February, Phil, we're still back at 2009 prices on the Case-Shiller Index. So this thing, to a large degree, has just gotten started on a national basis. So I think that we could, to classify it as a bubble that is unsustainable because, prices are rising way too rapidly, beyond people's willingness or ability to service the debt. We're not there yet. But I mean, if we keep seeing double digit gains for the next 2 or 3 years, mm-hmm. for example, then definitely we would be in bubble territory, because I think that would have to be driven by continually falling interest rates, because I don't see incomes in the United States staying anything. The best they're going to do is stay flat, and my guess is that they will continue to slightly fall and fall and fall over time.
Robert Campbell publishes the Campbell Real Estate Timing Letter. The May issue is out, featuring market timing signals for 17 major U.S. cities. You can't live without it. More at realestatetiming.com. Bob, we've got a second here. Tell us how we can subscribe to the Campbell Real Estate Timing Letter.
Well, you can go to my website that you so clearly delineated, realestatetiming.com, and you can read a couple sample issues, the kind of things that I write about, and determine then if that's the kind of information you want with real estate, and then you're going to be ahead of the curve, because I'm 100% data driven. My market timing model is 85%. It's been accurate to an 85% degree over the last oh God, how long has it been now? 82, almost, 30 years.
Wow.
Over 30 years.
That's impressive.
So it's been very remarkable, and it's been very satisfying to me that I found key data indicators that you can follow that give you a very, very good idea which way real estate prices are going to go. But I'll tell you one thing. Here's another thing I think people should know, that I think the next real estate downturn, because this is another, Fed-driven boom in housing prices, that when the next downturn comes, I think that it may not be as bad as the last bust we experienced, but it may be close to that bad, Phil. So I tell people that one of my favorite sayings is you can buy at any time in a real estate upturn and make money on the one condition, that's that you know when to get out.
Yeah.
And most people don't. I mean, selling is more important. It's because preservation of capital is the first rule of money, of protecting your money. And so you're going to have to know when to sell to get out of this thing, because I don't think that we're going to be in a organically driven market where the trends can go off and keep going up for 3 or 4 or 5 years, just little by little by little. Now it's a boom or bust economy, a bubble economy that we live in. We're experiencing it right now. So you can make money. You can make money while the sun shines, but when it's time to exit stage left, as I'm telling all my subscribers, you better be ready to do that, unless it's a house you live in and you can afford it. But if this is spec money, you got to know when to get out.
Like the president, you got to have an exit strategy, right?
You got to have an exit strategy. Right.
Robert Campbell, thanks for talking to us today, Bob.
You're very welcome, Phil. Thank you for having me.
Thanks to our guests, Garth Turner and Robert Campbell. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.